Yeah, this is such an important point. And if we're losing people here, please try to pay attention to this, because the SEC as an entity, and I had to take my SEC exams when I went to New York City back in '93. I spent my summer studying for my Series 7, Series 63 exam so I could become a licensed broker-dealer and trade at Bankers Trust. And that agency was created on the back of the stock market crash in '29, because that damaged a lot of consumers. Now, my mom, she's 78 years old. She lives in San Diego, California. She owns property assets. She also has some Ethereum and some stable coins, thanks to me. And it was there to protect maybe people like her from buying the wrong stock that was, who knows, pumped and dumped and never been, actually regulated. And it was created to protect that consumer.
Yep.
And so, like you said, it always has this lens of protect the consumer, or if you have said maybe it goes to the lowest common denominator. Ultimately, it was created to protect someone from fraud. The whole country lost money, the world lost money. Whereas the CFTC was created to actually help create products, create liquidity, regulate those. So even the mentality is one of innovation as opposed to protection, which isn't bad, but it changes the flavor of how they behave.
Yeah, and with great respect to the SEC, for which I have a great deal of respect, I do think they do need to rethink this notion of consumer protection that basically says, if you're rich and sophisticated, what's called an accredited investor, you can invest in anything you want. But if you're young, which almost by definition means you don't have a lot of assets because you're young, right? You will in time. If you're young, you can't engage in anything but the most commoditized, stable, and that's not going to grab their attention. So we've got to find some way, I think the SEC's got to find some way to reconsider this and open up more avenues to investing. You can't have reward without risk, right? I mean, I'm saying this as a former regulator, right? We've got to find some give in the system. It's not the job of regulators to stamp out all risk. Risk is part of life, right? The original concept of our securities regulation was don't stop people from investing. Just give them adequate disclosure, true disclosure, right? If firms say something is something, it's got to be true, right? Give them true disclosure, but let people make their own decisions. And I think we need to get back to that concept in investing. It's not the job of regulators to squeeze all risk out of the system. It's to illuminate risk so that market participants, whether they be young and engaged in crypto or older and investing in pension funds, can know what they're getting into.
It's a great point, and I found myself a little frustrated as I've come back into the crypto space for the last year, and I start looking at it through the lens of just as an investor, and I look at, is a cryptocurrency asset a security? Does it pass the Howey test? And as I start to look at it, part of me stops halfway through and say, wait a second, we're asking the wrong question, aren't we? We're using an antiquated case study and story to look at a new token. Who cares if it passes the Howey test? What are we doing with that? Why is the SEC involved? Shouldn't we be empowering the use of this information?
Absolutely. That's where we've got to get to. And this generational thing, I always come back to that in my analysis of this, because a generation moves forward and they take these ideas with them. And I think the legacy, not only just the legacy financial system, the legacy regulatory system is on the parapet with a revolution going down beneath them. And I think they've faced the same risk that the legacy system is. If they don't evolve with the times, they're likely to be run over with the times. This new generation is impatient for being able to do financial transactions instantaneously without Big Daddy telling them which ones they can do and which ones is too risky for them.
Right.
And I think the regulators need to have the same light bulbs go off that the legacy financial system is.
It's tricky when your institution was created, 100 years ago to do just that, or your institution was created to create liquidity and empower and innovate, actual new instruments. So you got these two things, and now, looking at these things saying, okay, is a token a security? Is it a commodity? Which I guess is my next question. You clearly said Bitcoin is a commodity and we're going to now put it as a future, as an exchange. Then you crossed over to Ethereum and I think made that decision. Talk to me about that decision. Is Ethereum a commodity? And then how do you start to look at other tokens? And then how does it work with SEC remit going forward?
Yeah, so it's challenging.
Yeah.
The final decision about Ethereum was made by my successor. We had done a lot of the early work on that, so I don't want to speak for him. I'll let him do that. Bitcoin, I was very much engaged in that decision. Bitcoin operates very much like a commodity. I mean, it functions in the market like a fixed supply commodity. One of the criticisms of Bitcoin is its volatility. And I tell people that's not a design flaw, that's a design feature. Commodities 101, if you have a fixed supply commodity and demand rises or falls, there's only one reaction, price reaction. That's the only thing can make up. Even variable commodities like oil are very volatile. 2 years ago it was below zero. Now it's $100 or thereabouts, right? And yet you can adjust the supply of petroleum, up or down. It takes time to get the wheels flowing, but it's an adjustable supply. So Bitcoin is not flawed because it's volatile. It's a direct reflection of the fact that it's programmed scarcity, that scarcity is programmed into it. So Bitcoin functions very much like a commodity, very much like a digital form of gold, a very good store of value, not a particularly effective means of payment, and yet for its miners, it does serve as a means of payment for their efforts. So Bitcoin is a very unique, but the thing about crypto, again, it's a shorthand label for a much, much bigger re-architecting of money. We say crypto, people often refer to Bitcoin, but then there's stable coins, there's security tokens, there's so many aspects to crypto. As you know, as your readers well know, there's thousands of different cryptos, more creating all the time, and some have greater or lesser value propositions. Some of them are absolutely fascinating. I read white papers regularly. People send me, we're designing this new thing, and I learn something from every one. I mean, there's some really, really forward thinking going on out there, and it's not going to slow down. But crypto is more than that. It's NFTs. It's payment systems. It's blockchain uses for both wholesale and retail. I mean, this is a true, I think, revolution in the whole concept, the whole way we do finance, the whole way we move money around the globe, the whole way we are going to price value. And I'll give you one more point. Yeah. Throughout most of human history, money has been valued in commodities. Throughout most of human history, fiat money was either a commodity, a silver coin, a gold coin, or when we were on the gold standard, priced to a commodity. The dollar was priced to gold. Currencies were priced to gold. It's a short period of time in human history, the last few decades, where most of the world's goods are priced to a currency, the dollar. In the future, currencies may be once again priced to commodities, and that commodity is very likely to be a digital one.